Hello, I'm Mitch Goldberg. Welcome to Be the Boss of Your Money. This is a live stream. This is about personal finance. It's about investing. It's about being better with your money, taking control of your financial situation. You know, it's very easy to lose control of your financial situation. Your money takes control of you, or lack of money, that is, and you need to take control. You need to be able to improve your own lot in life. I don't think anybody's going to do it for you. So we need to talk about things. We need to talk about personal finance, financial education. That's what this is all about. It's not about the stock of the day, but it is about helping you understand stock investing more. It's about helping you create a plan to get yourself out of a hole, or about taking what you have, which you've been successful in accumulating, and making sure it could last a lifetime. That's what this show is all about. Today, stocks hit new all-time highs after that blowout jobs number we had this past Friday. PMI numbers came out really strong. And you know something? I don't get overly excited when the stock market goes down. I don't get overly excited when the stock market goes up. But what I do is look for the upside and the downside and keep an even keel. That's what today is all about. So the big word of the day, inflation, because I think that's what you're going to hear about an awful lot going forward. So let's roll the intro. Let's get into it. It's going to be a very high quality, high impact educational show. Hello, everyone, and welcome. I'm just going to add LinkedIn to the stream. Okay, so if you're watching wherever you are, thank you so much. I really appreciate it. I know your time is valuable. It's precious, and it means a lot to me that you chose to spend of it to, and it means a lot to me that you chose to spend some of it with me. I would be a terrible actor because, I don't memorize lines. I just speak to you from the heart. And that's the beauty of going live. When you make a mistake, it's okay. You just move on because I'm talking to you. We're talking like it's a conversation. If you have any questions, please feel free to ask your questions in the comments. I will see them. I will answer them. If you're watching this in the replay, I want to welcome you as well. This is going to be a deep dive, really, into what's going to be the big buzzword, the big scary word, and that is inflation. You're going to hear a lot about inflation, and I want to make sure that you understand what it is and how it works. Inflation doesn't mean that all bets are off. There's a few ways to look at inflation, and there is some upside to some inflation. What we are concerned about is the economy is starting to pick up so much steam that maybe we're just behind the 8 ball when it comes to inflation. And that's what we need to get into. So I'm going to explain to you what inflation means, why it could hurt, what you could do about it, what it means for your future. And the fact is, a lot of you probably don't have to do anything. We're talking about long-term cycles, and I'll give you my final view on whether or not I think high inflation is something to worry about, because too low or negative inflation is also something to worry about. So we're going to get into this quick with a share screen. While you're watching this, if you do give it one of these, give me a reaction, a heart, a thumbs up, what have you. I'll see who's out there. I'll see your name. Let me know where you're watching from. I always enjoy seeing where people are watching from. So let's do a share screen. We'll do that now, like so. I'll put myself up in the corner here. Okay, you see me? I'm up here. Hey, yo, up over here. So the Dow was up 374 points, up over 1%, new record. NASDAQ up 225 points, up 1.67%. S&P up 58 points, 1.44%, going further and further above the 4,000 mark. New record there. Gold is finally moving. I think gold at 1,729. You see that over here? It's been holding 1,700 pretty good. The topic here is if you're worried about inflation, then why isn't gold moving up? Oil backed off a little bit, which kind of runs counter to the inflation idea. And the 10-year treasury was off a touch, still a little over 1.7%. But after Friday's huge employment figures, about 915,000 or so new jobs were created, well above expectations. And it looks, economists are pretty much unanimous that the job growth is going to continue. So that continues, and the VIX still below 20. Why it was up today? Some people are worried they're hedging. That's what it means when the VIX goes up. See 17.91. If it goes up a little, it means professional investors are hedging. They're paying a little bit more money to hedge their portfolios. By the way, those hedges, I think, is actually bullish. I would rather see people hedge their portfolios and just blow out of all their stocks at one time and cause a limit down day in the market, wouldn't you? Okay, so let's move on a little bit because we've got a couple things to look at. All right, let's take a look at crypto. Let's make this embiggen. Let's embiggen a little bit. That's not really what I wanted. Here's what I wanted. So let's take a quick look at crypto. Crypto, just about 59,000 on Bitcoin. Ethereum continues to stay over 2,000. Mark Cuban says he is 60% in his crypto portfolio. He's 60% Bitcoin. He is 30% Ethereum and 10% other crypto. Well-known YouTuber Graham Stephan says he's 60% Bitcoin and 40% Ethereum. So those are the popular cryptos. We talk about crypto a lot here. So just, I feel I have to incorporate crypto into the content, into the conversation, because if I'm not, then I feel like I'm not really doing my job. Enough of you are in crypto that you need to know where it is. By the way, Boeing almost up to 260. GE continues to move. Energy was down across the board, but the list I want to show you is a little bit different. It's amazing how quick I could be in the screen share. It used to take forever if you clicked on something, but consumer discretionary had a big day. Well, you would think so. If people are making more money, more people have jobs, then that means people are going to be spending money on luxuries. I call the consumer discretionary ETF, or the consumer discretionary sector, I call it the splurge indicator. If you want to know if you want to know if investors are bulled up on consumers splurging on things that they don't necessarily need, you look at XLY. And XLY had a pretty good day today, up over 2%. Communications were up. Technology had a pretty good day. Industrials had a good day. Overall, with the exception of energy, this was a pretty good day across the board. It wasn't just like a handful of stocks lifted the whole market. This was, I would say, very inclusive. And the fact that the S&P finally broke out of a multi-month funk and is hitting new records, and the fact that the FANG stocks haven't deteriorated. In fact, they're now perceived as, because they had such good earnings recently, that they're perceived all of a sudden as maybe less expensive than people believed. Okay. So things are all looking like green light. Financials are up. We've been talking, I'm going to stop the share screen. We've been talking about how the economy is improving rapidly, gaining ahead of steam quickly, a lot on this show. We've been talking about it really since late last year. And what I've been saying is the bull case is that the second half of this year, we see a really strong rebound in the economy. And then very early in this year, I changed my mind. I said, hey, the rebound, the big recovery, the strong economy of 2021 in the second half, it's here now. And there are still people who are waiting for the market to go back down to where it was last March to get back in. Really? Hey, I'm not sitting here telling you I thought the market would go up this much. I did say, I watched a couple of my past videos in March of last year, that I'm a buyer right after at the bottom. I said, I'm a buyer. I'm starting to nibble. I'm not selling. I'm a buyer. And then shortly after that, I said, I think we're going to hit new highs within a year. I said it. I have a video. I said it, and I'm sticking with it. So we're hitting new highs. Is the market up too much? I think the stock market has so much momentum, and it's so hard to find reasons to take money off the table. This right now, this scenario that we're in is about as bullish as I've ever seen. Well, sure, the market's the highest it's ever been, so you should be the most bullish. What I mean by that is, what I mean by so bullish. What I mean by so bullish is that, technically speaking, just about everything I follow is working very well, very positive. The charts are looking good. Any thought of tech stocks giving gains back is more or less off the table now. Industrials, people were thinking financials, too much too soon. Maybe the whole strong economy this year is already factored into those stocks and it's already time to sell them. All of those are going away. And when we received the PMI numbers today, Purchasing Managers Index numbers, it just confirmed the blowout, huge employment figures we saw on Friday. The March non-farm payroll numbers were just a blowout high number, crazy number. And it looks like things are continuing as states open up. Now, there's two things that could knock the market down. I'm just checking the time here. There's two things that'll knock the market down, that could knock the market down. And they both bear watching, but for now, I'm not making changes on these. I mean, the fact of the matter is, as certain assets go up in price, I'll take a little off and I'll rebalance that money into something else. But it doesn't mean I do that every day, every time. I'm not one of these people who's been saying for the last 10 years, it's a bubble. The market's up. It's a bubble. There are just some people who say the market's in a bubble whenever the stock market goes up. I actually feel bad for those people because they're going by an emotional knee-jerk reaction because they're so scared from the previous market disasters. I think people like under 30, especially under 35, are not scared at all because they're all bulled up. I could tell you that we could have a bear market and how bad it is, and you say, yeah, I'm a long-term holder. Until you go through it, though, you don't really know how bad it is. And then the people who are like, I would say like 45 and over, are just still so scared. When the market goes up, they go, but what if it goes down again? Because they remember how bad it was in 2000 and 2008. All right. But I don't go by that. I look at where we're going, not where we're from. I do look at history for lessons because I feel I have to, check my ego at the door every day. I have to sell myself before I could before I could put my clients' money in risk assets like stocks. So there's two things that could knock the market on its keister. One is COVID variants. Now, Michigan reported a pretty sharp rise in COVID cases. Most states are reporting a rise in COVID cases. And the British variant, the B117 is spreading. It's more catchy, more viral, and it's more dangerous. Yeah, that's going around. But I don't think that shuts the economy down. And the reason I say that is because so many people in this country have been vaccinated. I mean, literally, like everyone I know has gotten at least one jab already, and I'm not talking like everybody 60 and over. I'm talking people younger than me also. Like it's so many people. I think something like over 100 million people, over a third of the country has gotten at least one jab, and probably 25% of the country are fully vaccinated. But the population that is 70 and over is pretty richly vaccinated. The whole point of social distancing and shutdowns was not to shut down the economy. It was to keep the hospital surges from happening. So a lot of people are catching COVID, but it seems that hospitalization rates aren't going up as much, and neither are death rates, which means that a younger cohort of people are probably catching it, but younger people have a much higher chance, a much higher odds of beating it. Okay. I'm not trying to minimize the long-term effects that many people are having of this disease. I myself am vaccinated because I believe in vaccinations deeply. I believe in them tremendously. And I have friends who are my age who've already had COVID, and 6 months to a year later, these people could be having neurological and heart issues for the rest of their lives as a side effect from COVID. So I'm a believer in it. So I don't think rising COVID cases puts the kibosh on the economy. It might slow things down a little. Maybe, instead of accelerating at 6 to 8% GDP this quarter, in the second quarter that we're now, so maybe it knocks off a 0.5% to 1% of GDP, but it's still pretty darn good growth. And we're still vaccinating more and more people every single day. I think one day over the weekend, we vaccinated over 4 million people. So the vaccinations are happening really fast, and they're happening with the right age populations. And a lot of states have opened up vaccinations to people 30 and over, and some people who are 16 and over. All right. So I don't think that's an issue. The second big bugaboo that could knock the market on its keister and end this great bull market and just ruin the party is inflation. Now, people have been on the lookout for inflation and worrying about inflation for a very long time. And I know it's, by the time we all completely agree that there's no more inflation, we'll have inflation, right? It doesn't have to work that way, but we like to say as soon as we all forget about it, that's when it's going to happen. Well, everything is cyclical. So let's just go back a little bit. I want to really get into this, okay? If we see inflation a little bit above the Federal Reserve's target rate of 2% inflation for consumers, they'll let it slide. They said the Federal Reserve, Jerome Powell, who's the chairman of the Federal Reserve, has already said, if we see inflation go above our target for a little while, we're not going to worry about it because we think inflation is transient, meaning it's not going to be long lasting. It's temporary. So we're going to keep interest rates super low. We're going to keep buying like $120 billion worth of bonds every month. We're going to put on the Federal Reserve's balance sheet and create cash and printing money. So they buy $80 billion of Treasury securities and $40 billion of mortgage bonds every month. That's what the Fed does, and just keeps long-term rates lower, keeps the liquidity flowing into the market. And already we've seen long-term rates kind of stall out at 1.7%, even though economic numbers are surging. One reason interest rates are being held down is because the 10-year Treasury at 1.7%, if you look in Japan, Germany, England, their 10-year yields are much, much lower than ours. So I think our 10-year Treasury is just attracting a lot of foreign buyers who say, well, that's a great yield, what we're getting in the United States, 1.7%, compared to what they're getting at home, which is 0. So there's two kinds of inflation if we get it. There is the kind of inflation where producers have to pay more, and that's companies that make things, okay? If companies that make things have to pay more for raw goods, like oil or plastics or lumber or copper or food, if their input costs go up, well, then they have to make up for that by raising their prices to end users like you and me. If they can't raise their prices because one company raises its price, you'll find a substitute company to buy the products you need. And it's very competitive. So it's very hard to raise consumer prices. If it's very hard to raise prices on consumers. So if that happens and input costs go up for producers, that means they make less money. So their profit margins get squeezed. So that could hurt the stock market. That could hurt corporate earnings. And it could cause a contraction in certain valuation metrics like PE ratios. So that's how one way that it could hurt. Inflation could hurt. And we're already seeing rising, skyrocketing costs of plastics, of lumber, of copper, and other commodities. And then if they could pass along these costs, and we are seeing price rises, by the way, in input costs for corporations. Make no mistake about it. Prices are going up. Energy is going up. You see what the price of a gallon of gas has done over the last few months. Demand is up. Supply went down. So energy has been going up a lot. And people are driving more and people are flying more. And they're driving and flying a lot more. It's actually the rate of growth in those two metrics are very steep now. But if companies could push their prices up and raise prices to consumers, then you get consumer price inflation on people like us. And all of a sudden we start getting less for our money. We can't buy as much stuff. Your $200 that you spend at the supermarket only buys you now $180 worth of goods that, based on prices a few months ago. So if that happens, then the Federal Reserve says, wow, inflation's getting out of hand. Inflation could cause recessions. It causes boom and bust cycles in the stock market. It ruins the competitiveness of a country. Countries with sky high inflation are become less competitive compared to other nations, and they lose their efficiency. They become less efficient in terms of every monetary unit of output from every monetary unit of input. Productivity goes down. So if consumer price goes up, then the Fed has to step in and raise interest rates. Well, if they're raising rates, that could slow things down and makes the cost of goods and services more money. It's more expensive. And then that could hurt the economy because now not only you're paying more for things, but it slows the economy down. And that could cause a recession or at least cause a slowdown in the economy. So if we do get inflation, it has to work its way through. So first you see some commodities go up and then companies say, well, if the products we use to make, if the inputs we use to make our products go up, we'll find different inputs that are cheaper. We'll try to reconfigure things until they can't do that anymore. And then they just have to either absorb price hikes or pass the price hikes on to consumers. Either one is bad for the stock market. So that's why you're hearing all about this now, about inflation. And this is going to be the big buzzword. Every bear you see on TV, everybody says, well, things are going great, but we do have to watch out for inflation. Look, we always have to watch out for something in every bull market. There's always a worry. It's never going to be a worry-free market. That's what we call it. That's what we call stocks risky. If it was worry-free, then you just have all of your money into short-term T-bills, and you wouldn't have to worry about anything, except that inflation will eat you alive, and you won't even notice it until it's too late. So those are the things that I want to say on inflation. So there's a little thing that I want to put on the screen here, a picture that I posted the other day. Another way that inflation hurts, especially when interest rates go up. See, if inflation goes up, interest rates go up with it. The reason short-term interest rates aren't going up, even though the 10-year Treasury yield has gone up and mortgage rates have gone up, is because the Federal Reserve is controlling short-term rates. It's not letting them rise. So in this environment, I know it was really cool. I just switched cameras, right? So in this environment, if long-term rates go up and short-term rates stay down, that's actually very good for banks because banks make something called a net interest margin. No, banks make something called a net interest margin. And that's the difference between what they pay you in a savings account or a checking account and what they make on loans that they lend out to businesses and consumers. So banks could make a lot more money in an environment where there's a big spread between short-term rates and long-term rates like we have now. So we have what's called a very steep yield curve. So we are in a very good economy. So we could get inflation. We could get a little bit of inflation. If we get a little bit of inflation that really is transient, so if we get a little bit of inflation that it really is transient, then that means the Federal Reserve will be very comfortable to keep rates low because they think the surge in inflation will go away. If the Fed is wrong and the rise in inflation is not transient and it sticks with us, and the Fed then means, if they get that wrong, then now they are behind the eight ball. We call this the horse is out of the barn. And then they close the barn doors too late. The horse is already gone. That means the Fed then has to say, we were wrong. Inflation is more powerful and longer lasting and higher than we expected. We're going to have to pull back on our bond buying programs to keep funding the economy. And we're going to shrink the money supply, and we're going to raise our short-term interest rates, federal funds rate and the discount rate. And guess what happens? People get spooked. The market goes down. The yield curve becomes flatter. It hurts profit margins at banks. Now, one or two rate increases might not necessarily hurt the stock market and the economy. It might be just enough to rein in inflation expectations just a little bit. But if your expectations are prices are rising, and if you think, to give you an example of when the pandemic started, people were buying gym equipment, for example. If you went to buy gym equipment last summer, go online, try to find gym equipment, it got very expensive because supply went down, demand went up, and things got very expensive. But now the prices of home fitness equipment have dropped a lot. So the supply has caught up. The demand has gone down because people are going back to their gyms. And all of a sudden, prices are in line again. That's more or less what the Federal Reserve expects with inflation for the overall economy. If they're wrong, then they have to catch up to inflation by jacking up rates, pulling back their bond buying program, slowing down the economy, because if you slow down the economy, you slow down price increases because you're sapping demand a little bit. That's not good for corporate profits. Consumers become miserable because everything costs more money because inflation is high. Warren Buffett calls high inflation the misery index. There's a reason for that, because you're miserable because you can't buy stuff anymore with your money. Your money's not worth as much. So that's the big bugaboo that people are worried about. And that is a term, the bugaboo of inflation. That's what we use on Wall Street. And it's a silly term, I know. So that's what people have to watch. There are a few people out here. I just want to say a couple of hellos. Rick, I see you. Hey, man, you got your first of 2 Pfizer vaccinations this past Friday evening. Good for you, buddy. I got my second Pfizer shot. Today is 2 weeks. And you notice that Bill Gates is dumping most of his stocks, except he's buying a lot of, okay, maybe. Hate to say that I told you so. Yes, crypto is moving. I know. But her 401k plan is professionally managed, like Enron. No, it's not so bad. Okay, so that's the story for the day. I hope you found value out of this. We could talk about money printing and lots of other things, but I think we're getting a little in the weeds, and that would be a better story for another day. So thank you so much for watching. We're going to play the music. Let's play the music. and then we are going to get out of here for the day. All right. I'll speak to you guys tomorrow. It's going to be a good show.